I see people teach this wrong all the time. Traders think that if you get a credit in a vertical spread, you must be collecting premium. And if your trade is a debit, you must be paying a premium. That's just wrong, and I'm going to show you why. Not knowing what an option premium really is can make you pick the wrong trade, make the wrong management decision, and cost you big money. In this video, I'm going to talk about what premium is and why it matters so much. Then I'm going to use that information to dismantle the credit versus debit spread myth and demonstrate how to actually tell if you are a net premium seller or buyer. First, what is premium? Well, premium is the amount you pay over and above the intrinsic value of something. Intrinsic value is the actual measurable value of something. For example, an ounce of gold in raw form is worth an ounce of gold. But sometimes things can cost more than their intrinsic value. And if something is trading for more than its intrinsic value, then we would say it's trading at a premium. We regularly pay a premium for things in everyday life, and the options market is no different. Bear with me for a little analogy here. This is an Hermes handbag that is selling right now for about $40,000. I think I pronounced the name properly. If not, feel free to correct me in the comments. Well, this is a very similar bag that I found on the internet that is selling for $499. Now, I'm sure that it's possible that the quality of materials on the $40,000 handbag could be higher than the $500 handbag, but I really doubt it's $39,500 worth of difference. It's obvious that there's a huge premium for the more expensive bag. I assume this is because of the name on the label, even though both bags appear to have about the same intrinsic value. Now again, I'm not an expert in handbags or fashion, so if someone wants to educate me in the comments, feel free. But this is an example of what a premium is. Remember, premium is the price you pay over and above the intrinsic value of something. In the option world, premium is synonymous with extrinsic value. The total value of an option is comprised of two parts: intrinsic and extrinsic value. Intrinsic value is the difference between the exercise or strike price of the option and the current value of the stock. For example, if we look at a stock trading for $50 per share and a call option on that stock with a strike price of $45, we would know that the option has an intrinsic value of $5. The intrinsic value is the actual exercisable value of the option. As long as the stock stays at $50, that intrinsic value will stay the same. It doesn't matter how much time is left or how much implied volatility changes, the intrinsic value is still $5. Well, let's say that the option was actually trading for $7. Well, that would mean that the option has an extrinsic value of $2, or in other words, a $2 premium. In fact, the technical term for extrinsic value is actually the volatility premium of the option. Well, let's go back to our example. If implied volatility were to suddenly double, the value of the option would increase significantly, even though the stock price didn't move. The intrinsic value didn't change because the stock price hasn't changed, but the option premium did change. So now that we know what an option premium is, what does this have to do with credit versus debit spreads? I see people teach this wrong all the time. Traders think that if you get a credit in a vertical spread, you must be collecting premium. And if your trade is a debit, you must be paying a premium. That's just wrong, and I'm going to show you why. Getting a credit does not automatically mean that time decay is helping you. Similarly, paying a debit does not automatically mean that time decay is hurting you. Let's look at two trades to demonstrate this concept. I'm going to do this using vertical spreads. If you're not familiar with the vertical spread option strategy, let us know in the comments below and we can help you with that. If you are familiar with vertical spreads, make sure you pay extra attention to the second spread I'm going to demonstrate because it may be a bit surprising compared to what you've probably been taught before. This stock is trading for $377.39. We're going to start by building a simple bull-put spread. We'll sell the 376 strike put and buy the 374. Well, this trade would be a credit of 79 cents per share, or $79. Well, that means the most we can make is $79, and the most we could lose is $121. For this trade to reach maximum profit at expiration, the stock just needs to be above $376. Well, it's already above $376, so we don't need the stock to move. Is this trade a premium collecting trade or a premium spending trade? Well, let's take a look at it. Both options are out of the money. That means they have no intrinsic value, so the entire value of the option is extrinsic value, which, as I mentioned earlier, is the same thing as premium. We're receiving $10.45 for the option we're selling and paying $9.66 for the option we're buying. So we're bringing in more premium than we're spending. This is a premium collecting trade, and time decay is working in our favor. Trade number 2. We're going to build a vertical spread using the same strikes, but this time we're going to use calls instead of puts. I'm still buying the 374 strike and selling the 376, so it's still a bullish trade, but this trade is a debit to our account. It's a debit of $1.21 per share. Well, that means the most we could lose is $121, and the most we could make is $79. The exact same as the credit spread. If I screenshot and overlay these trades on top of each other, and I love this software, by the way, it's the software that our subscribers at Tactical Income get, you'll notice that the trades have identical profit and loss graphs. They're identical in every way. But the question is this trade a premium collecting trade or a premium spending trade? Well, let's do the math and find out. The option we're buying costs $14 at the asking price. It has $3.39 of intrinsic value, so it has a premium of $10.61. The option we're selling has a cost of $12.79 at the bid. It is in the money by $1.39, which means it has a premium of $11.40. Well, that means we're bringing in 79 cents more in premium than we're paying. It's the exact same amount as in the credit spread. In other words, even though this is a debit spread, time decay is working in our favor, and we are collecting premium. As you can see, credit versus debit doesn't really matter. Sometimes someone will say to me, well, I like to get a credit because I'm bringing money in instead of spending it. Yeah, well, technically that's true. The credit you're bringing in isn't actually doing you any good. You can't spend it, you're not earning any interest on it, and the money isn't yours to keep until you exit the trade. In fact, that money is actually being held by your broker to cover the margin cost of the trade. In other words, when it comes to how it impacts your buying power and your account value, there is no difference between a debit and a credit spread. In fact, the only reason you should pick one over the other is because out-of-the-money options tend to have narrower spreads between the bid and ask, and are therefore easier to manage. Also, because the spreads are narrower, it's usually easier to get a better return on risk without having to negotiate the spread. Well, this is the real reason why most vertical spread traders use credit spreads for non-directional trades and debit spreads for directional trades. It has nothing to do with premium collection or time decay. So now that we've demonstrated what premium actually is and how to tell if you're a premium buyer or seller, what are you going to do with this information? Hopefully, it helps you understand to a deeper degree how options really work, and that will help you understand why you're making money or why you're not making money. Understanding premium is a critical concept for helping to manage existing trades. I'll put a link to a video where I go into that in detail on covered calls in the description below. If you've enjoyed this video, or if you've learned anything new, please hit the subscribe button, hit the thumbs up. It really helps me to be able to continue to put out new option-related content.